welcome to ICT Core Content Study with me. So, how this is going to go is I have a Google Docs document here, and I will take notes from every single episode, and you can have an access to this Google Docs document from the description. And yeah, we are basically just gonna go through every single month and have a study of all of his concepts established in these videos. So yeah, the first episode is about elements to a trade setup, and basically what are you having here is, first of all, you need to identify what's the context behind the trade, um, surrounding the idea, what's the framework, and yeah, first of all, what ICT kind of represents here is, or presents here is, four different conditions. You have expansion, retracement, reversal, and consolidation. So you actually have to identify, first of all, in which phase of market are you trading right now in. Because maybe if you're in consolidation, you don't really want to execute. Maybe if you are able to identify that we are in an area where you could see a reversal, or if we are having a reversal, you shouldn't trade with the overall higher time frame trend, because the reversal could end up giving you a loss. So we are actually going to put out here that elements to a trade setup. We have four different conditions of the market. So we have one, expansion, two, retracement, three, reversal, and four, consolidation. And then I'm going to continue watching the video and making some comments and taking notes when it's appropriate.
In other words, trending, a retracement or pullback, altogether reversal, and obviously when the market's doing nothing, it's consolidating. But really, we all learned in the Market Maker series that there's really no such thing as the market doing nothing in consolidation. It's actually accumulating orders. Now, the other characteristic we use for defining elements to a trade setup is using these four criteria for context and framework to specific reference points in institutional order flow. The first one is order blocks. The second one is fair value gaps and liquidity voids, liquidity pools and stop runs, and lastly, equilibrium.
Okay, so these are the four main reference points in terms of institutional order flow. So these are the main areas that you want to see certain reactions happen. So let's say price makes a sharp move to the upside, and obviously it needs to retrace before it can move further up. So price, for example, wants to balance to the equilibrium price point, and that's why equilibrium is an institutional order flow point of reference. So we want to take that on note. So there are let's say there are four main reference points for institutional order flow, and those are obviously order block. Let's put order block, and we want to have OB equals OB, fair value gaps and liquidity voids. So we are just going to short it FVGs, liquidity pools, and stop runs. So yeah, we have basically buy side liquidity and sell side liquidity. There we go. And for obviously equilibrium, which is basically just 50% of given price leg. I'm sure he's going to get more into that.
Now, understanding those two characteristics together will give you a greater understanding of market efficiency paradigm, how the smart money interprets price, and how they influence the general populace or the speculative uninformed money. It's going to be a rather illuminating tutorial, actually. You're going to be able to look at the marketplace with an expectation of knowing what tool to apply based on what the market's providing.
Okay, sorry, I'm just going to put additional information here. So we are going to have like so to have a good trade setup, you have to be aware of the condition of the market and what is your main reference point in institutional order flow. So condition of the market and there you go. And now he's talking about how smart money kind of works and what is the market efficiency paradigm.
You right now. It only takes a second or two to look at the marketplace, determine, okay, what characteristic are we trading in? So that way you can build a context or a framework on how you're going to approach the marketplace. Sometimes you'll have right away an issue where you can say, I'm not going to do anything because the market's consolidating. I'm going to be waiting. The other three conditions are going to be providing you an opportunity to take action relative to the tools that we couple with those conditions or context. Now, the interbank price delivery algorithm, or what I always refer.
Okay, next thing, interbank price delivery algorithm, aka IPDA. So these are kind of basics that you have to know when you are introduced to ICT concepts. And don't worry, this is nothing too complex. So we are going to have IPDA. There you go. And let's continue.
Referred to as the algo or interbank algo, is the actual, basically artificial intelligence. It's a price engine that when we receive our price for our currencies, it's actually 90% done by electronic algorithms. So it's all computer based now.
So yeah, price is pretty much delivered algorithmically through computers and stuff like that. So we're going to put that information there. Um, yeah, let's just have that there as of now.
It used to be open outcry in the pits, but there's no longer an auction market. It's all AI, and it's based on the principles I've been teaching for about 7 years now. You're not going to learn these things because, number one, no one's going to believe that it exists. There is this movement away from human involvement with market making. It's become much more efficient to be electronically based, and these things are programmed by human beings, obviously, and those intelligence are limited. So, while that is probably unsettling for some of you that are listening to this thinking, well, I thought I had a free market I was trading in. It's actually not. It's highly manipulated, especially in the foreign exchange, which is what we're primarily dealing with here, because of the nature of it being so manipulated. The fingerprints, if you will, are easy to see once you understand the operations and the conditions that the market maker interbank price delivery algorithm functions. So when the market does what it's doing, it gives you indications, it gives you fingerprints or clues as to what you should be expecting next. And that's where your anticipatory skills are going to be coming in. You're not going to know these things right away the first time watching this video. It may go over your head. But for some of you that have already went,
And yeah, let's just put a little bit more information here. So for people who don't really know how ICT works, it's based on this algorithm, and you pretty much can see the similar patterns that the algorithm prints. So I'm just going to put that there as well. So the algorithm prints similar patterns every day. Uh, and operates in operates always in the same way. So yeah, I would say that by learning what it does, you can learn to trade very efficiently. There you go. There is nothing really more to this, so we're gonna skip a little bit further.
okay, the interbank algo. Okay, obviously, there's going to be times when the market goes sideways or it's in a consolidation, or what I refer to as a holding pattern. Now, when this happens, the market will be looking to do an expansion. Okay, so all markets start from a consolidation and move into an expansion. That means there's an impulse move or an impulse price swing. After that impulse swing, okay, either it goes back to a consolidation again, or it goes to a retracement. When the retracement happens, it goes back down into another level of expansion. Or after the expansion, it can go to a reversal pattern. After the reversal pattern, it'll see another retracement, then back to potentially a consolidation. These four conditions, they interchange throughout the ups and downs and ebbs and flow of the marketplace. You're only going to get one of these four conditions. Now, you're probably saying, okay, well, that's a lot. I need to know one of these things to make a trade. No, you just need to know.
So yeah, basically, market consists, and the price delivery only has these four conditions, and you can be very well off by being able to understand in which condition market is trading right now and where is it moving next probably. And yeah, just build your trading strategy on top of these things. Maybe you have a rule that when market is in consolidation you don't trade, and that's generally speaking very good one.
Where it's at right now, where it's likely to go, and where it came from, and over the course of the month of
So yeah, you should be able to identify where it's likely to go and where it came from. So basically, if you are at the end of retracement move, you can say that price came from retracement and it's likely to go to expansion because it's going to expand the current trend. So this is not that hard.
September, you're going to get a lot of understanding about how to know where the market's going to go next. And that's going to fill in a lot of the gaps that you've had with Teach Me Directional Bias ICT. The main thing is the consolidation begins with everything. All the moves that take place in the marketplace start from a measure of consolidation because that's where the markets are building orders. So the market maker.
This is important information. Every single move starts with consolidations because when market is consolidating, it's basically building orders and liquidity to both sides of market, and then the market makers like to sweep liquidity, trigger all the orders, and then run to the other side so that the retail traders lose in these kind of circumstances. So what I would put here is all moves almost start with consolidations and consolidation periods because that's when orders are being stacked and liquidity is being built. There you go.
Keeps the market in a tight range or a defined range until there's enough money on both sides of the upper and lower end of the range that's being defined by the consolidation. Whichever one has the highest amount of money to be absorbed, that's the direction it's going to move in. We don't always know what that is, but we wait for the expansion. When the expansion occurs, that's when we get the clue as to what the market is most likely going to be doing. And then we wait for either a retracement or another consolidation or a reversal. But we always wait for the first expansion that gives us all the insight that we need to make a decision. Now, sometimes it may expand so far that we can't do anything with it. We have to wait for the retracement or the next consolidation. There's nothing wrong with that. It's all normal. You're not going to catch every move.
So basically, yeah, not always you are going to know where market is going, so you should wait for an expansion to be able to identify a little bit clearer of the, like, what is the real direction of the market. So I would say that I will write here that often you need to wait for, excuse me, often you'll need to wait for the expansion to know what market will do next. Let's put that.
The main thing is just understanding these four individual characteristics to a trade setup, because price is delivered by one of these four conditions. It can't be any other way. Now, what is expansion? Now, expansion is when price moves quickly from a level of equilibrium. Now, expansion couples directly with the tool of an order block. Now, what's the importance of knowing expansion? Well, when price leaves a level quickly, this indicates a willingness on the part of the market makers to reveal their intended repricing model. Now, what does that mean? Well, if we're in a consolidation, okay, or a point of equilibrium, if price were to move up quickly, that would give us an indication of looking for a bullish order block. We don't want to chase price. We're going to wait for price to come back down into the order block. Where is that going to occur? Well, what do we look for in price? The order block that the market makers leave near or at the equilibrium price point. So I know what you're thinking. Okay, Michael, this is already going over my head. Give me something.
Okay, so basically here, a good element for a trade setup is when price is at the point of equilibrium, you want to, let's say you are bullish, you want to see a bullish strong reaction for the equilibrium price point. And so when you have that strong reaction from that level, you then want to identify an order block from that new price leg, and you can then long that, because you can understand that when it's reacting very bullishly from the equilibrium, you understand that price is establishing bullish order flow, and you should be possibly looking for longs. So that is a good sign. So what is expansion? We are putting here the expansion is when price moves quickly away from equilibrium. From equilibrium level. Okay. Yeah, and yeah, let's put that when price heavily, price reacts heavily when price reacts heavily from that equilibrium level. Let's say in example bullishly, um, you can expect price to trade further to established direction, and then just look for the order block to enter. Yeah. There you go.
Examples, no problem. I'm going to show you that right now. As you see here, there's a consolidation in the blue shaded area, very clear defined consolidation. It's got a clear discernible high and low, and the equilibrium price point is directly in the middle of the high and the low end of that range. You can simply take the...
So this is an good example of this kind of scenario where you basically, what do you have here? Well, you have a consolidation in this area. Yeah. Now, then what is the equilibrium? Equilibrium is, well, this is the range, first of all. So equilibrium is 50% of that range, so it's going here. You can see that. Now, here we tap that equilibrium level and trade heavily to the upside. Now, it's same example that we wrote there. When you have a heavy reaction from equilibrium, you have this order block level here, and this is a level where you could simply go long based on the previous stuff that we saw here, that we wrote about here. So yeah, in this scenario you are entering from this bullish order block because of this initial strong reaction from the equilibrium level. Then
The next one is a retracement. Now, what is a retracement? Retracement is when price moves back inside the recently created price range. Now, years ago, I think it was in 2012, I did a webinar called Trading Inside the Range. And a lot of folks that were following me on one of the forums that is pretty popular on the internet, they went head over heels when they learned this simple principle of understanding how you can trade inside of a range, and it doesn't even have to break out, it doesn't have to trend. You can define the range by a high and a low and trade inside that range. And that was the beginning basis point of how I brought a lot of people from that forum into the understanding of an order block. The order block was introduced.
okay, so retracement is pretty self-explanatory. You are just retracing. Let's say you're having a strong bullish price, like retracement is when price moves back inside of the recently created price range. So price moves back inside the recently created price range. Now you can trade retracements, and it's kind of like a counter trend trade usually. What is the importance? When price returns inside a recent price range, this indicates unwillingness on the part of the market makers to reprice to levels not efficiently traded to fair value. So yeah, basically market makers want to give fair value. So the price is shorting because they are then having like a fair value to buy more, because when price is high, it's in premium prices, and premium basically means just that it's expensive. So when you drop the price, it's you're kind of giving it a discount, and it's cheaper to buy. So then when it's cheaper, they want to buy it then, and so that's the basic thing here. And yeah, we are the main things to look for are main things to look for are fair value gaps and voids. And inside, let's say in the bullish range, you have a fair value gap that is a good target for price to move inside of that fair value gap before it's expanding further. So that's the main idea here with the retracement.
Okay, this is an example of a retracement. As you can see here,
And yeah, here you can see an example of a retracement. So this is pretty much what you can see here. So there you can see a fair value gap. Very nice. We are having a bearish price leg to the downside, as you can see in here. So yeah, the next thing is reversal, and that's obviously when price is reversing and going contrary to the current trend. So reversal is when price moves the opposite direction that current direction has taken it. So yeah. So we are, yeah, price is moving opposite direction to current trend. What is the importance of this? When market reverses direction, it indicates the market makers have ran a level of stops and significant move should unfold in the new direction. So, so meaning that if there is a lot of buy side liquidity, market makers take that liquidity out, and then market is basically reversing because they don't have any more uh, kind of fuel to go to the upside. They need to stab some of that sell side liquidity first, and that's why reversal happens. So so let's put that reversal happens when um, reversal happens when a sufficient amount of liquidity is being taken out from the other side of the market. And let's have a quick.
The reversal. The reversal is when price moves the opposite direction the current direction has taken in. So if we are looking for reverse, where stops would be.
Okay, and this is a good example. And here are here you have multiple examples of reversals happening. So basically, let's take a this. So you are basically,
And the market goes just above those levels and it rejects and goes the other way, or it goes just below those levels where there's an X and rejects and goes the other.
so yeah, here are multiple examples of a reversal happening. Um, First of all, let's say in here, you can see that we have trended heavily to the downside here. Then here are, with that red X, liquidity pool. Market steps that out, and then it moves heavily to the upside. Now, someone could say that price could still continue to the downside, but oh, excuse me. But when you are good enough in understanding where liquidity lies, and um, you can identify also what are the major liquidity pools that when price kind of takes those out, there is a higher probability of reversal happening. So just note that when price taps liquidity out, the reversal is like more likely to happen, like this example in here. Okay, then we have the last condition of the market, and that is consolidation. So what is consolidation? Consolidation is when price moves inside a clear trading range and shows no willingness to move significantly into any direction. So we see no no significant moves to any direction. And what is the importance? Well, when price consolidates, it indicates that the market makers are allowing orders to build on both sides of the market and expect a new expansion near them. So the key point is that expansion can be expected soon after the consolidation. Due to market accumulating orders. There you go. And what do we look for in price? The impulse swing in price away from the equilibrium price level that is found exactly in the halfway point of the consolidation range. So yeah, we already looked at the equilibrium and how to utilize that. When you're having that consolidation range, you can identify the equilibrium price point and see if the price is reacting at any point heavily from that level. And here is an example of consolidation, so you can see what's happening and what's going on in here. So basically, this is the range low and this is the range high here, measured from the bodies of the candles. Now you can see what's happening inside of here. Price is not leaving the range established. It's consolidating, not moving anywhere. That's the first thing. That's how you identify consolidation. Now, how you can utilize this is you can see what happens here. This wick takes out all of the liquidity, which is when you take sell side, where do you want to go? You want to go for the buy side. And is because consolidation is building orders, as you can see, I wrote here that expansion can be expected soon after consolidation due to market accumulating orders. So when market is consolidating, it's accumulating orders here and here. So here are people's sell stops and here are their buy stops. So smart money basically wants to take out all of the sell stops with that wick and then run for the buy stops. And here is the equilibrium point that from which you could have bought market breaking structure and equilibrium of that consolidation.